So today we are going to talk about chapter number 6. Chapter 6 is basically a chapter that has been divided into about 6 different topics. One is cash, the second is investment, third is account receivable, fourth is inventory, fifth is fixed assets or property, plant and equipment, and number 6 is current and long-term liabilities. So we are going to start with accounting for cash. So what is cash? Cash includes everything: coins, currency, checks, money orders, checking account, and savings accounts. When we are talking about currency, it could be dollar, and sometimes there could be foreign currencies such as Canadian dollar or Mexican peso or euro or pound. It's reported as cash and cash equivalent, consisting of such item as certificates of deposit, treasury bills, usually called T-bills, and money market funds. So if you look at the balance sheet, you will see a one-line item in the balance sheet under assets, specifically under current assets, as cash and cash equivalent. Cash equivalent simply means something that can be converted within 90 days as cash. So certificate of deposit, treasury bills, and money market accounts, if they can be converted into cash, into dollars within 90 days, they will be considered cash equivalent, and we can put them together with cash. There is something is called restricted cash. A restricted cash could be for several reasons. Could be restricted by a creditor, that you have to maintain a certain amount of money in your checking account. It could be restricted because you have already promised to invest that cash in buying a land or building a factory, for example, and must be reported separately, because restricted cash means the cash you cannot use in day-to-day operation. Because cash is so easily taken means if you have a dollar bill, for example, in your hand, there is no name written on it. So for example, your name is Adam. Your name is not written on a dollar bill. So whether the dollar bill is in your wallet or in my wallet, in either case, both $10 bill looks the same. So it's very hard to say who really owns that. So it is, when it says easily taken, means it can easily be stolen. All right. Mark, I understand some of you may be thinking that every dollar bill has a different number. Yes, true, they have a number, but we usually do not consider that number to really anywhere to find. So for example, if I get a $10 bill, if you claim that it's your $10 bill, you most likely do not know the number on that dollar bill. It can be easily taken means it's stolen, concealed, or misappropriated. Misappropriation, the word you're going to see most often in accounting and finance, is outright it's stealing. Means somebody is stealing cash or money. Most companies have developed elaborate internal controls, that's a very important word, to safeguard their cash. Controls for cash involve in mailroom or retail sales area for receipts. So for example, if you go to 7-Eleven or a gas station or a convenience store or Walmart, you may see there are cameras looking directly into the cash register. Basically, they're saying whether the cashier is putting the cash in the cash register or they are putting in their pockets. Treasurer for custody. Treasurer is a high-ranking official in the accounting department. They usually kept the control of cash and cash equivalent. And the controller, another high-ranking official, is basically record. Record means making journal entries, making debits and credits of the incoming cash or outgoing cash. Internal audit is another department outside the accounting department that basically tracks of these journal entries and coming and going of cash and other assets in the company. Cash and cash equivalent, these are time deposits, certificate of deposit, and high grade US or foreign securities. So what are foreign or government securities? T-bills, T-bonds, US T-bills, US T-bonds are government securities. There are other bonds, other securities, government securities too. For example, war bonds. I mean, usually we introduced these things during World War I and World War II. Government securities, usually T-bills, T-bonds. T-bonds are like 10-year and 30-year. T-bills are usually 1 year. They have a maturity date, means their life is 10 years or 30 years, or the T-bills is most likely 1 year. Certificate of deposits, you deposit the money in a bank for like 2 years, 3 years, 6 months, that kind of. High grade US or foreign currency means you have foreign bonds that either offered by foreign companies or foreign government. Compensating cash balance agreements, cash, liquid asset available for day-to-day use. So when you see a word cash without anything in the preface or postfix, is the cash that is available for day-to-day use. Balance should not be restricted, means it's not a restricted balance in any way. Restricted amounts separately disclosed. Okay. Compensating balances, borrowing company always agree to maintain minimum balance. So for example, you have a business and you want to borrow say $10,000, but the lending company such as a bank says you will always maintain a $2,000 balance in the bank. So basically you are borrowing the money from Chase Bank. First you have to open an account with Chase Bank and you need to maintain. So basically you are borrowing $10,000, but you are using $8,000 at any given moment. Long-term assets, not cash. So the compensating balance, compensating cash balance. So for example, if there is a balance sheet and it has current assets, under current assets you have cash and cash equivalent, and you also have compensating balance separately and restricted cash or compensating cash. So these are the three different items. So restricted cash doesn't have to be a current asset. It could be a long-term assets. So it will be listed under long-term with long-term assets such as land, building, and machine. The next topic we're going to talk about is petty cash. So what is a petty cash? Petty cash is used as an office or source for cash for a small immediate purchase. So petty cash is for immediate small purchase. So for example, a mid-sized company may maintain $500 or $600 cash. So for example, if they need a printer paper, a $50 printer paper, or they want to order a donuts, 3 dozen, 4 dozen donuts, or they want to pay for the pizza the boss has order for your lunch break. So these kinds of things is usually, so buying a stamps, for example. So it is a petty cash, but petty cash is another line. It could be another line item or in various reports, but in the balance sheet, it would be reported with the cash. Okay. There is a designated employee, basically accounts payable or account receivable person, who will maintain that, and they will keep the receipt every month. So for example, at the beginning of month you have like $50, the boss gave you $550. So on January 1st you have $550, and on January 31st you have only $25 left. So what you need to do in order to get the next $500 or $600 from the boss, you will have to give an explanation and provide all the receipt which combines together for $525, because at the beginning of the month you have $550 and you have used all of it except the $25. So once you give them, the boss will give you another $500 or $600. A petty cash ticket basically serve as with a voucher or with a receipt. For each petty cash payment, the custodian prepares a petty cash ticket, because who I paid, how much I paid, what was the purpose of it, date and time. An impress system is a way to account for petty cash. an Impress system, it could be an Excel sheet that you can make. A petty cash ticket could be a receipt made by hand or through a computer. At any time, cash plus ticket must be total the amount allocated to the petty cash fund, as already talked about. Okay, then we talk about replacing the petty cash. When a cash is missing, short, or over, is recorded for unaccounted cash. So for example, you can provide your boss for $525. You have to provide a $525 explanation, but you could have come up only for 520. Your boss might say, hey, you need to get better with this. I need an exact amount. But if there is a dollar short or a 25 cents or 50 cents over or under, usually people don't care about it. When replenishing the fund means the boss is giving the company either debits either the associated expense account incurred or the asset purchased with the fund. So for example, you throw a party, the boss gave you $500. So what you're going to do, debit annual Christmas party expense $500. Oh, no, not $500. And you credit cash for $500. That's what you have to do in the system in order to make sure that all the money is accounted for. The next topic we're going to talk about investment. So what is an investment? Whether you are an individual or you are a business, if you have an extra money, what is the extra money? So for example, suppose you are running a household, all right? Either you are paying rent or you are paying a mortgage. So first you pay the mortgage. The second, you pay the car payment. The third, you pay the insurance. The fourth, you pay student loan, for example. Then you pay for your groceries, your clothing, your medicine. And now after paying all the bills, end of the month, you have $1,000 left. That $1,000 is called an income, disposable income, or an income, or the money that is available to you after taking care of all the expense. So you would like to invest that money. You can put it in the savings accounts. You can buy some investments. It could be a treasury bill. It could be a US government bond, 10-year bond or 30-year bond, or you can buy a shares in the share market. For example, you can buy a share for Google or Microsoft or Apple or Walmart, whichever do you think you want to buy, you can buy. So investments are usually short-term investment and long-term investment. Short-term investment is something that if you purchase today and you sell within a year. So for example, today is November 3rd. You purchase today and then you sell it on March 13th. So from November 3rd, 21 to March 3rd, 22 is less than 1 year. So that means you invested your investment was short term. But if suppose on the other hand, so this is short term because it's less than a year. But if you purchase and sold it on say October 31st, 2023, so that will be considered a long-term investment because the duration between these two dates is greater than 1 year. Here, the duration between these two dates is less than a year. Okay. Now we're going to talk about two different kinds of securities. One is called marketable securities. The other is called trading securities. So how do we classify which one is a marketing security and which one is a trading security? Marketing securities are assets that can be liquidated to cash quickly. Something that can be sold quickly to convert. Liquidated to cash simply means converted to cash. So for example, you have $5,000 worth of Google shares in your account. You can sell it in a minute. So that will be considered a marketable security. They are usually short-term liquid securities and can be bought or sold on a public stock exchange or a public bond exchange. Means, for example, you have TD Ameritrade account, investment account, or through Merrill Lynch There are multiple of Fidelity. So if you can buy and sell securities at a very short notice, then it would be considered a marketable security. These securities mature in a year or less, and it can be either debt or equity. Means debt means they can be bond, or equity means they can be a stock. So a stock means a Google stock, or a bond means it could be a government bond, or it could be a private bond. Private bond means a bond issued by Microsoft, for example. And equity means a stock of a Microsoft. Trading securities that have been purchased by a company for the purpose of realizing a short-term profit. A trading security, that company, so you are a company, suppose you are a bakery and you are investing in another company, you buying their security for the purpose of realizing short-term profit. For example, you think that you are using a stove from ABC company and you think these stoves are really good and the share price of this stove is gonna spike in within the next 3 months, for example. So today you bought for $10 and 3 months down the road you sold it for $50. So you make a $40 profit. It's a short-term profit because you made it less than a year within a 3 months period. Okay, companies do not intend to hold such security for a long period of time, means no more than a year. They will only invest if they believe they have a good chance of being compensated for the risk they are taking. Means if they truly believe that the price of the share is gonna go up, then they will invest in it. Okay. Business invest in a variety of companies and stock and bonds. So any business who has an extra money, they will invest in various. So for example, you want to invest. So suppose you have $10,000, and for that $10,000, what you can invest? You can invest in real estate. You can invest in a small business. You can invest in a stock market. You can invest in a bond market. You can invest in precious metals. So as an American citizen, you have a lot of opportunities or a lot of outlet to invest in various kinds of investments. The same opportunity is available for businesses as well to park their extra cash they do not need right at this very moment. An investor is the owner of the bond or share. It is very obvious. Investee issues the bond or stock to the investor. So investee is the company. So for example, you are an investor, but for example, Google company, the parent company of Google is Alphabet. So if Alphabet is issuing the bond or the stock, so they will be considered investee, and you purchasing it as an investor. A security is a share or interest representing financial value. So a security is a share or interest. So a share is basically a piece of ownership. So there are two types of securities. One is called equity securities, which is basically a stock ownership, and that is called investments is in the notes or bonds payable issued by another company. So you, but the purchaser, become a creditor. So you are the over here. If you invest, so you become invest. If you do the investment here, you are an investor. When you purchase a equity, when you purchase the debt, you become a creditor. All right. So that's the difference between an investor and a creditor. Debt securities can be further classified into three specific types based on how long the investor intend to hold the investment. One is called the trading. Trading is a debt the investor plans to sell in the near future, just like we have discussed previously. Held to maturity is a debt that investor intends to hold as the ability to until it matures. So when you purchase a stock, the stock has an unlimited life. When you purchase a note or a bond payable, it usually has a finite life. It could be a life of 5 years, 10 years, 15, 20, or 30 years. There are very, very few bonds out there in the market that has infinite life. I believe during the World War II, the British government issued a infinite life bonds. I don't remember exactly what was the name of those bonds, but those bonds might still be available in the market, but they are very, very few, if there are any available at this moment, because the bond, the creditor, sorry, the debtor has the right to purchase back those bonds or those notes payable. Okay. So until they mature. So for example, if you purchase a bond today, a 10-year bond, a US government issued T bond for 10 years, and you or the business decide to hold it for the next 10 years, then it will, the security will be classified as hold to maturity. Available for sale, debt investment is a debt secured that is not a trading security or a held to maturity. So if you purchase a security and you are not interested in selling right away, and you are also not keeping it for the rest of the life of the bond, then it would be considered available for sale. So why we decide to keep these secure or categorize these securities in three different, because when we sell a security, so for example, today I purchase an asset, this pen, right? I purchased this pen for $10, and tomorrow I'm going to sell it for $20. So $10 is my profit. Or if I purchase for $10 and 5 months later I sell it for $5, that means I have a $5 loss. So these gains and losses needs to be reported into the income statement, and these losses and gains increase or decrease our income, and they have what we call it different tax implication. So when you file a tax, these gains and losses are taxed differently compared to ordinary income that we make as an individual or as a business. Okay. These unrealized gains and losses means, for example, I purchased this pen for $10. 3 months down the road, this pen is now $50. So that means I have a profit of 40, but I have not sold. So you have, in order to realize the gain in your statements or in order to pay the tax on it, you have to sell it. If you do not sell it, then there is no tax on your gains or losses. So unrealized gains and losses are called paper gains or losses, because the amount, whether it's go up or down, since you have not sold, so there will be no gain, but it will be considered unrealized gains and losses, and they have a different treatment which is beyond this. This we're going to discuss in Intermediate Accounting 2. If you ever take Intermediate Accounting 2, how do we treat unrealized gains and losses, you will learn from there. Generally, unrealized gain and effect do not affect until you actually sell the security. Okay. An unrealized loss occurs when a stock decreases after an investor buys it but has yet to sell it. Okay. We have talked about realized gains and losses. Gains or losses said to be realized when a stock you own is actually sold. So for example, I bought this pen for $10. 3 months down the road, I sold it for $50. So I have a realized gain for $40. And I will mention this gain in my investment as an investment gain in my tax return next year, and it will be taxed differently. So we're going to stop here, and we will continue with our next topic, receivable, in the next